So to talk about smart contract risk, you really have to start with the classic exploit, and that's called the DAO. And this is ancient history, but this is a very important episode. And for you, again, many of you will work in this space. Maybe you're not working in this space right now, but I predict that you will, especially given that you're taking these 4 courses. So you need to know a little bit of history. And this is a very good starting point. So again, this is going to be a type of exploit that is on the side of a logic error. And there's other issues with this contract that we will explore, but let's go and dive in to the DAO. So DAO, that is Decentralized Autonomous Organization. So it was set up shortly after Ethereum was launched with a really interesting idea. So this was the first of its kind. And essentially the idea was that people would send Ethereum to a smart contract called the DAO, and they would get DAO tokens. And those tokens basically gave you the right to vote on essentially a venture capital fund. So think of the DAO. The purpose would be to allocate token to various startups. And then if the startup is successful, then basically the DAO would profit from that. And those that held the token would have like a rate of return. So just think of it as a venture capital fund. So in traditional finance, investors give the venture capitalists some funds, and those funds are usually locked up for a while, and it could be actually multiple years. And then the venture capitalist deploys those funds to invest in various different ventures. And then if they work out, then the original investors, they actually make a profit. Okay, so again, there's a lockup, and this is essentially analogous, but in the DeFi space. Okay, so this is a smart contract, and it's designed by source.IT. But at the time, it was such a kind of shocking idea that you've got a company, if you even want to call it that, it's a contract. There's no CEO. There's no board of directors. There's no headquarters or anything like that. It's just a contract, and the DAO holders are voting as to what to invest in. So it really a fascinating idea for kind of the next type of business, if you want to call that, in the world. So it was very, very exciting. So again, this is on the Ethereum blockchain. It is code that is available for anybody to take a look at. So this open source nature, again, as I've emphasized, creates an opportunity. So many people can scrutinize the smart contract and basically potentially find a vulnerability. So this is launched on April 4th, actually between April 4th and April 30th in 2016. And again, you can take a look at it. So you can go to Etherscan and go to the particular block, and you can see this. So at the time, a huge amount of Ether was allocated to this particular contract. So 14% of all of the Ether at the time was dumped into the DAO. And the DAO was actively traded on exchanges. And this is an early example of a tokenization. So in 2016. So let's take a look. And this is, again, I'll be going to Etherscan a number of times. You can do this with the information, and you can see all of the details for that particular block, and the gas, the contract hash, the timestamp, all of this stuff is available, including the actual source code. So that's what it looks like on Etherscan. And CoinMarketCap in 2016 was just a startup on its own. And it's kind of interesting to look at this in its own right. Check that out. The price of Bitcoin, $731, which is much different than today. Ethereum, $1885. And notice that the number 5 token here, we've got Litecoin, we've got Ripple, and then the number 5 token is the DAO. And you can see the available supply of DAO. You see the trading volume, and you see the price at about 17 cents. The total capitalization is $200 million, which again is a large chunk of Ethereum. So this is what happened. So on June 9th, basically, some developers reported that there is a bug, and the bug is called reentrancy, and it's a fairly well-known. It's especially well-known now after the DAO, but this is basically a bug that makes it possible to empty funds from a contract. And interestingly, just a few days later, the founder of source.It said the DAO code was not vulnerable to this type of exploit. So let me give you a basic intuition as to what this exploit actually does. So effectively, 2 lines are out of order. So the code's fine, except for 2 lines that are flipped. And essentially, it allows the attacker to continue to withdraw from the contract without a check of the balance. Okay, so think of this in centralized finance or commercial banking in the following way. I go to the teller physically at the bank and withdraw $100, and I got the $100. And then I hand another slip and ask for another $100, but the account isn't checked to see if I've got that $100. So this just keeps on going on time and time again until the bank runs out of money. Okay, so this bug, extremely serious. But, source.It said not a big deal for the DAO. It's immune to this problem, but the DAO is attacked on June 17th, 2016. And an attacker goes in and drains 50 million of Ether, which is, again, so it's like 30% of the Ether in the account. Okay, so remember, if we're thinking of the price of Ether today, this is a multi-billion-dollar attack. Okay, so this is not a small attack. Okay, so 30% is drained. And then, and this is very interesting, another group called the Robinhood Group uses the same exploit and drains the other 70%. So the contract's completely drained. Now, the difference with the Robinhood group and the DAO attacker is the Robinhood group actually pledges to give back everything that they've drained to the original people that put the ether into the contract. Okay, so I guess appropriately named Robinhood, and not to be confused with Robinhood, the fintech app. There's nothing to do with them. Okay, so basically, June 17th, the contract is drained, 30% is gone, and 70% could be returned to the users. So remember I told you with the venture capital fund that there's usually a lockup period? So you put your money in, and then there is a certain period before you can withdraw. Well, it turns out that the DAO smart contract had something similar to that, but it wasn't multiple years. It was 28 days. So effectively, I say that the contract is drained. It will be in 28 days. So there's a hold on, but it's going to happen. If nothing changes, then it will be drained. So when I say they drain everything, it's a sure thing. In 28 days, 30% will go to the attacker, 70% to Robinhood, and people are faced with a loss of 30% of their token. So again, there's many layers to the story, which is fascinating. But the community, the Ethereum community, started to debate as to what to do about this. So there's a couple of different possibilities. This contract was flawed, and well, this is what happens with a flawed contract. Somebody will exploit it, and you pay the price. And next time, maybe you learn. So the other possibility, given the 28 days, is that the community might actually consider the possibility of rewriting history and going back and fixing the contract. Okay, so that's a big debate. So in the meantime, take a look at what happened to market value. Notice that the number 5 is the DAO still, but it loses 56% of its value. Ethereum also loses some value because it is linked to the DAO. Remember that I told you one of the key properties of blockchain technology is that the ledger is immutable. And that means that once something's there, it's there forever in theory. We also talked about the sort of situations that make that fragile. So we talked about a 51% attack, where you've got the majority can basically go and change history if there is agreement amongst the majority. Well, it turns out in the case of Ethereum, there was agreement to go back and to fork the Ethereum blockchain and to basically undo that contract. So that would mean that nobody lost any ether. And that's exactly what happened. So again, very contentious decision. Many people were split on this, especially the Bitcoin people. And it's just really hard to imagine anything like that could happen in the Bitcoin space because no smart contract to begin with. But to actually rewrite history, very contentious. So with a fork, the idea is you've got a shared history, and then the protocol changes. And it also turns out that the old version still lives. And the old version that includes the flawed smart contract, the DAO, is called Ethereum Classic. And it is a token that is traded today. It's actually not a small token. Okay, and in that particular space, 30% of the Ethereum Classic tokens were lost to the attacker, and Robinhood Group gave back the 70%. So we'll talk more about these forks. And I'll come back to this particular example. But if you're holding Ethereum, when you fork, your wallet is automatically populated with a new token. You have the old token, Ethereum, but you've got a new token called Ethereum Classic. Okay, so there's another layer to this story that we'll talk about later on in the course when we talk about regulatory risk. It turned out that after all this has happened, the US Securities and Exchange Commission decided that the DAO token was a security. And actually, we'll go through the sort of framework that you use to determine if something is a security or not. But it's kind of obvious that the DAO token, in hindsight at least, was a security. It is like investing in a venture capital fund, and that would be a security. You expect a profit on your actual investment. So that basically is the end of the DAO. If it is a security, then there's a lot of regulations that we'll go through later on in the course that apply to it in the US. So again, there's so many different layers to this particular story. So given I've already talked about a fork, let me just give you a little more information on forks. So there are different types of forks. There's a hard fork and a soft fork. So soft fork is a minor software upgrade, and it means that everything is backwards compatible. So even if you didn't upgrade, your program that you're running is going to work fine. So think of Ethereum as having two pieces to it. So there's some code that runs a program on a node, and then there's a database, which is the Ethereum blockchain, which everybody has on their computer that is a node. So a soft fork, they happen fairly regularly. And if you upgrade, fine. If you don't upgrade, you don't have to. But most people do these upgrades, and they're not contentious. And there's no consensus mechanism that's necessary for that. So that's kind of like a soft fork. Hard forks are major changes. So when we're talking about the DAO and basically the forking of Ethereum to change history, that's a big deal. So that is a hard fork. And the hard fork is not backward compatible with previous versions. And with the hard fork, all of the nodes need to follow the new rules. So in terms of the type of hard forks, there are basically two types. One is something that's planned. So the idea is floated as an improvement proposal, and it's vetted, and there's widespread agreement. We have a date and a target block where it's going to be, where the upgrade or the fork is going to happen. So that's a planned, and there's been many of those. But there's also contentious. And I put ETC in parens because ETC, or Ethereum Classic, that was a big deal. So there was a lot of disagreement over that particular fork. Bitcoin also has forked many times. There's many different versions of Bitcoin that are out there. And these are hard forks also. So remember, we talked about forking. And forking is something that applies to software in general. And it is, in a way, an advantage of the DeFi space, that you can do an improvement very quickly and create something that's better. The Ethereum fork that created Ethereum Classic, and I say created, but Ethereum Classic is just a continuation of the original protocol. That was subject to a big debate. So let me give you some examples, other examples of a hard fork. And we're actually just going through this right now in terms of Ethereum. By the time you see this course, London hard fork will be deployed. And it basically, there's a number of improvements in that fork. But there's bigger things. So like a really big change would be to move, for example, from proof of work to proof of stake. So change the consensus mechanism. That is a huge change. Okay, so there's other things that, especially in Bitcoin, there's a lot of debate over block size. It's really difficult to get agreement in the Bitcoin community, and they debated years over whether they should increase the block size, which would give them more transactions per second and potentially reduce the cost of transacting. But it was very contentious because the miners in Bitcoin are very powerful, and they like the small block because that means their fees are really high to get into the Bitcoin blockchain. So they get paid by a fee, and they also get paid by the reward of newly minted Bitcoin. So another example is changing the hashing algorithm. So we know that Bitcoin uses the SHA-256, Ethereum uses a KCOC-256. Those are completely different. So an Ethereum miner is useless in mining Bitcoin and vice versa. But you can imagine it would be very contentious to change the hashing algorithm, because that means that all of the hardware in the proof of work space would be obsolete. Okay, so again, this would be like an example of a hard fork that would be contentious. So this is what like a fork looks like. You've got a shared history on the left, and then you've got your updated software, but the original software remains. So think of the blue as what, so the first three boxes are the shared history that Ethereum Classic and Ethereum both recognize. And then when the fork occurs, the original software is the Ethereum Classic, and the green boxes denote the forked version of Ethereum that the community agreed upon. So again, the wallets are identical. If you had 1,000 Ethereum before the fork, then your wallet would have 1,000 Ethereum after the fork and 1,000 Ethereum Classic. So it just comes into your wallet. So again, I've got some data, recent data from CoinMarketCap, and you can see that Ethereum has much larger market capitalization than Ethereum Classic. So most people stuck with the agreed upon change in Ethereum, but nevertheless, that fork is still valuable. So into your wallet, if you had, let's say, 10 Ether, into your wallet, all of a sudden comes 10 Ethereum Classic. And you can see that that's actually valuable. So you get something. And it's kind of interesting, this whole process of forking, where something just comes into your wallet. And it's kind of like the old version or a new version, another fork. So, so this is, again, you share the history, but you've got a new set of transactions that happen going forward. And they're two different chains. So, so in the basement here, we've got a miner that used to mine Ethereum, but then basically didn't have enough memory to actually continue to mine Ethereum. So we actually switched over and we are mining Ethereum Classic. So again, it's the same hashing algorithm, the KCAC 256 for Ethereum or Ethereum Classic. And given the right machine, you could mine on either of them, but we're constrained in terms of the memory of our machine, and that's why we're forced to do the Ethereum Classic. So again, this is contentious. So take a look at the history here. I'm showing you the hash rate, and on the y-axis, it is the number of terahashes per second. And this is a billion hashes per second. And the scale is a log scale, so don't be misled by the scale. But what I wanted to show you is what happened at the point of the fork. So you can see before the fork, we've got a shared hash rate. And then after the fork, not that much happens with the hash rate for Ethereum because the community agreed to support the fork. But you can see that it's a rough start for Ethereum Classic, where the hash rate drops very dramatically immediately. But then some miners see the opportunity that Ethereum Classic would be supported, and you can see that the hash rate jumps up and stabilizes. It tracks the Ethereum hash rate, but notice that the Ethereum hash rate is 22 times greater than the hash rate for Ethereum Classic. So I mentioned the London upgrade that was originally proposed by Vitalik a number of years ago. And that is basically scheduled for August 4th or 5th, 2021. I've talked about this briefly, but there's a number of improvement protocols within this fork. And this is agreed upon by the community. Some of them were more contentious than others, but I've mentioned the 1159 before, and let me mention it again because it's very important for this protocol. So all of these improvements make it a little more friendly to interact as a user with Ethereum. So I mentioned previously the problem with the size of the base, or with the problem with the gas fees in Ethereum. And this improvement, 1159, what it does is it simplifies. So the user is going to pay a gas fee that is automatically calculated by the wallet. So with MetaMask, it would immediately calculate the base fee, and that would be enough to get that transaction through the process. And this is really important. The base fee doesn't go to the miner. The base fee, once it goes in, is burned. Okay, so the idea here is that the miner will be compensated with a tip. So if you want your transaction in as soon as possible, then you attach a tip. And the tip will put you to the front of the queue, and you'll get in much faster than somebody who doesn't put a tip in or has a very small tip. Okay, so in the past, the miners got everything. Okay, so the tip and you think of an equivalent of a base fee is all in the gas fee. Okay, so this is different and it's important. And it's important because the Ethereum that's going to be burned. There is no hard limit on Ethereum. Actually, most don't know that. They know that Bitcoin has got 21 million as a limit, and they know that, well, some people know that we stopped mining Bitcoin in the year 2140, but Ethereum doesn't have anything like that. So it is inflationary. So the other kind of good thing about the burning of the base fee is that it acts as a deflationary force. So Ethereum are being created on every block, and there's a reward for the miners in doing that. But this is a way to actually counteract that to some degree by burning. And actually, indeed, some believe that that will make Ethereum more valuable. So this is an important one. Let's not confuse this London mainnet when this is deployed. Let's not confuse that with Ethereum 2.0. Okay, so that is way bigger than this particular hard fork. So Ethereum 2.0 changes the consensus mechanism. So we go from proof of work to proof of stake, because that's a really, really big one. That is going to take longer, but will likely happen in 2022.